The current state of the U.S. economy and financial market seems paradoxical. On one hand, economic data points to a robust recovery, strong job growth, resilient consumer spending, and a rallying stock market. On the other hand, many Americans feel far from optimistic about the economy. This disconnect between hard data and public sentiment is puzzling. As someone who follows the markets closely, I've spent a lot of time analyzing this paradox. And in this video, I'm going to share my insights on the key factors contributing to this divide. Make sure you stick around until the end, because I'm also going to give you some practical tips on how to navigate this environment as an investor. Hard versus soft data. Recent economic data points to a strong and recovering economy. For example, the job market has been robust, with unemployment rates declining and companies continuing to hire at a healthy pace. Additionally, consumer spending has remained resilient, indicating that people are still buying goods and services. A key driver of economic growth is consumer spending, so the fact that consumers are continuing to spend is a positive sign. Here, take a look at this chart. It shows something really interesting. There's a big difference between two lines, pointed out by the red arrow on the right. Let me explain what it means. The golden line pointing down shows how people feel about the economy. These are surveys where they ask people questions like, "How is your business doing right now?" Or "What do you think about our country's economic situation?" And who knows if their negative feelings are just from watching too much news about things like the crazy political elections in the US. Maybe they just finished seeing stories about the wars in the Middle East, which are really sad to watch. But when they then get asked, "How are things going?" it's no wonder their first thought is definitely not good, man. Now look at the black line. This shows what's actually happening in the economy using real facts and numbers. Things like how many homes are being bought, how many products factories are making, and whether people have enough money to spend. These are hard data of the real economy. See how the black line looks a lot higher and better than the golden opinion line? That's the interesting part. While people's feelings make it seem like the economy's not doing well, the actual data shows it's doing pretty good. So why this disconnect between economic reality and public perception? What's fueling it? Let's break it down. Why the disconnect? Several factors likely contribute to the gap between economic reality and public perception. Negativity bias in media. First, we have the negativity bias present in today's 24/7 news media cycle. The constant broadcasting and publishing of negative stories around inflation, politics, global conflicts, and other crises creates an atmosphere of perpetual crisis mentality. Even when economic data shows improvements, people are constantly stuffed negative news narratives down their throat. If it bleeds, it leads, right? Take, for example, the frenetic coverage around Donald Trump in the United States. You can barely turn on the TV without hearing about Trump, Trump's controversies, and the political clashes surrounding Trump. And, well, if it's not Trump, then news channels are saturated with more anxiety-inducing topics, like wars, conflicts, natural disasters. This omnipresence of negativity inevitably shapes the public psyche. And guess what? This negative lens is then amplified by the echo chambers of social media. Social media echo chambers. Have you ever noticed how your social media feeds seem to show you more and more of the same types of posts or viewpoints? This isn't a coincidence. Predictive algorithms on platforms like Facebook and Twitter selectively show users more content that aligns with viewpoints and sentiments they've engaged with previously. So if someone interacts with a few fear-mongering posts about the economy struggling, the algorithm will keep feeding them more negative economic content in their feed. It's a vicious cycle that sucks you deeper into a negative echo chamber. You interact with one scary post, so you get fed similar scary posts. Before you know it, your entire social media world is telling you how everything is falling apart, and there's no hope. It's important to be aware of this effect so you can pop the bubble. Check authoritative sources, look at the full range of economic data points, and resist the temptation to doom scroll into an abyss of skewed negativity online. Stay curious and open-minded instead of letting algorithms lock you into a cynical echo chamber. Adding to the pessimism, we can't ignore the lingering psychological impacts of the COVID-19 global pandemic. Lingering COVID-19 impacts. The physical, emotional, and economic tolls of that crisis were immense. And yes, even though it's past, it still haunts many people's mindsets today. Households that endured income losses, health issues, grief, or other trauma from that period may understandably still view current conditions through the lens of recent hardship. And finally, debt burdens. While employment data is strong overall, many American households face heavy debt burdens from mortgages, student loans, credit card balances, and other liabilities. Carrying that debt load can dampen economic confidence, even for employed families, as significant portions of income go towards debt payments. Rather than boosting disposable income and savings, these strained finances shape an underlying unease about one's economic standing. Navigating the paradox. Folks, it is clear that there is a disconnect between what the economic data is showing versus the overall negative public sentiment out there. So what can you do as an investor? The truth is, for investors, this disconnect creates potential opportunities to rise above. At the beginning of the video, I promised to lend some practical tips on how to navigate this situation as a wise investor. So what can you do? First of all, ignore the noise. One of the biggest challenges is tuning out all the perpetual negativity surrounding us from the news media, social media, etc. It can be tempting to get caught up in the gloom and doom mentality and make rash, emotional decisions like panic selling your investments. However, successful long-term investors know to ignore a lot of that external noise and market chatter. Instead, you want to stick to evaluating fundamentals like a company's standing. When deciding whether to buy, hold, or sell, don't let the prevailing negative sentiment sway you away from a solid investment thesis. Next up, consider quality assets. With all the economic uncertainty, one potential opportunity is looking at high-quality bond investments, which can provide more predictable, stable income streams compared to stocks. Even though interest rates have risen over the past year, yields on highly rated corporate and municipal bonds are still relatively attractive compared to recent history. By adding some of these investment-grade bonds to your portfolio, you can collect that reliable interest income while waiting out the volatility in equities markets. This type of asset can help diversify your portfolio as well. And finally, practice selectivity in stocks. Even though the overall mood seems negative, the truth is there are still some companies that are pushing ahead strongly in this economy. Because some businesses are performing much better than others, it has become more important to carefully choose which individual stocks to invest in. By diligently studying each company to find the winners among the strugglers, expert stock pickers can potentially earn you higher returns than just blindly investing in the overall market average. To take advantage, look for investment managers with long experience. These seasoned professionals have the skills to spot good investment opportunities that the negative overall sentiment has caused others to overlook or misjudge. The key for investors is being able to navigate this paradox between negative sentiment and still constructive economic data. Don't get caught up in the perpetual storm of negativity, but also be selective and strategic in how you position quality assets and stocks that can compound returns despite the prevalent pessimism. Conclusion. As we wrap up this analysis on the paradoxical market environment, I want to review some of the key takeaways. We can't deny the striking dichotomy between the robust economic data out there and the generally gloomy public sentiment. However, it would be a mistake for investors to get swept up in that constant barrage of negative news and bias. Instead, now is the perfect time to stay disciplined and focus on rigorous fundamental analysis. In this paradoxical period, the key remains tuning out the surrounding noise to selectively capitalize on segments showing real potential. By navigating these waters patiently and wisely, you can turn this challenge into a fabulous opportunity for lasting wealth creation. And that wraps up our episode for today. As always, don't hesitate to leave your comments and thoughts below. Make sure to like this video and subscribe to join our journey to wealth.